now. There we go. Okay, so Empire Company. So these metrics here are showing us all increases. And the other interesting thing that this company does is it snapshots the financials right on the first page. So we also notice here these 3 years. So this is really important information because what it's doing is it's allowing us to establish trends. And as you can see, if you followed along, there's been very gradual increases in sales. And again, this last year, it's been another increase. So that's very promising for those that are looking for dividends or some sort of return on investment. You'll also notice that the dividends per share have also increased in relation to sales. So there's a lot of really interesting things in these statements. These are just the snapshot items. And so we'd want to probably go and look and see what else is going on, because this is just the income statement. This is the news, right? Did they make any profit? And if they've made profit, they have retained earnings. And retained earnings are distributed to shareholders in the form of a dividend. And you can see that they've received dividends significantly. I mean, every year they're declaring dividends. So that's also a good sign. So they talk about COVID. A lot of companies will be talking about COVID on their year-end annual reports. This just happened to be May 2nd. They had already seen March and April. And so they're in the midst of the early stages when these annual reports were created. So this was a really great chance for management to address it to the shareholders and other users. Now, think about where we were in May as to where we are now. It's a really different story because I don't know that we even thought we'd be where we are today. And it doesn't look like there's going to be much more change in the coming, well, in the new year anyways, in the early spring. So who knows what it'll look like this time next year. But they have addressed it, which is really interesting because we just didn't know. And so what the chair's message is, it talks about, you know, who they are. They have Sobeys and Safeway and Freshco and all through Western Canada and all across the country. So they talk about, you know, what their plan is and what's happened with COVID and what happened to them during that time. And what they're really doing is trying to address how we're actually going to come out of this. And so whether that still rings true for them at this point, I don't know. But I can tell you this, that many companies are just still trying to figure this out and navigate through this pandemic based on public health guidance. So again, they're doing the best that they can. Everyone is. We're all trying to cope in different ways. So anyways, it talks about all this legacy, et cetera. It gives you kind of the background of the company. So it's really good information. This is information that we don't have in the financial statements. This is all the other information we try to grab to help us make a better decision and also add context to the financial statements. So when we talk about the financial statements, we already know that, you know, we know this, we know about how they're dealing with COVID. We know about the substantial growth they've experienced in the last 3 years. We know all of that already. So when they go down and talk about this, you know, historic year, they were considered and declared in March an essential service. So it's a grocery chain. They remained open. They weren't impacted negatively by the pandemic. And so they're in one of those industries that could continue. And probably had the ability to generate those additional profits, but would they have been able to do that without being considered or labeled an essential service? Probably. The trend shows the last 3 years they've been doing that. So this also happened at the tail end of their fiscal year. So the key thing will be, what can they do this year? And with quarterly reports, you'll find if you go onto any stock exchange, you know, Globe Investor, Yahoo Finance, whatever, and you type in their stock ID, you can get their quarterly reports and the analysts will be all over it. So you can get real-time information with these public companies. So you can get a pretty good sense of where they're at. So I'm just going to whip down to the financials. And let's see, that's MD&A still. Always, there. So these are consolidated financial statements. I like them because they always have the nice green page and it's easy to find. So again, just going through this, we did this last week with Aritzia, but these are about, you know, they're all done the same. This is the great thing about IFRS and the standards. I did post a couple of videos in terms of the IFRS international reporting standards and what those really mean and why they do it. So these are all consistent with that. is telling us that the auditors were really happy with what they found. They talk about a new accounting standard. It may look different, so don't get too concerned. It's about leases and some other information we might want to look at. So again, they're very detailed. These have grown a lot since I ever started accounting. But international financial reporting standards require additional disclosure, and that's why they were so welcome in Canada, because the more information, the better for everyone. So if we look here, we'll be focusing on the balance sheet for the next little while. So I thought it might be worth just looking at it now. Now, we did kind of focus in on a lot of these when we looked at the cash flow statement, because the cash flow statement includes activities from operating, and it also includes activities from the long-term assets section, which we find right here. So tonight, well, we looked at cash. Cash is something we're controlling. So the video I posted for you is about controlling the cash, making sure it's in a safe place. And it's the textbook actually does a really good job of explaining what those control mechanisms are. So if we go back to what would we need to know for an exam? Well, you might want to suggest to a scenario what might be better cash controls for this organization. So you may want to, maybe, provide some guidance to management about what that might look like. So that's an example there. We'll talk about receivables if we have time this evening. If not, I can always make a video for that. And then inventories, which we'll be looking at. And they give you a note here. So note number 4 says there's something more you need to look at for inventory. So we're going to go and look at that right now. So let's go find note 4. We're going to cruise through the rest of the statements and see what we can find in note number 4. They talk about probably the valuation of it. And so, have I passed it already? My eyes are blurry. I don't think so. Let me know if I have. Seems like a lot of information to get to note 4. There it is, inventory. Okay. So a really short note, but what it's telling us is, of course, this is more information for the user, that the cost of inventory is recognized as an expense, like cost of goods sold, is this amount. And the company recorded $2 million as an expense for the write-down of inventories below cost to net realizable value for inventories on hand at the end of the year. There were no reversals of inventories written down previously. So that was nil last year. So what they're telling us here is that, if you think of grocery in this context here, there's lots of items, lots of inventory items across the board in all of their stores that may had to have been written down. There's lots of perishable items. There's things that break, things that you can't sell, just different things that they just can't get rid of. So the standard requires that companies report their inventory at cost or net realizable value. So here you see this net realizable value. So they've identified that they've done that. So what they're saying is the financial statements are very conservative. I want to present the worst case scenario to my users. If I make a decision based on the information in the financial statements, and that decision doesn't go so well, and it's because the company defaulted somewhere, or what they've really done is they've presented information that was detrimental to my decision, okay? So the way that these accounting standards go is we want to protect the users, but we also want to make sure they have the information that they need to make good decisions. So the reason we put inventory at net realizable value or cost is because if we were to sell this inventory today, what would we get for it? So if I'm making a decision and I know there's inventory on that balance sheet, if the company could sell it today, what would the cash be coming in? How can a company create cash flow, right? Through inventory. And if they can't sell it, what good is it to me? Okay, because that's cash. So the fact that they've told me exactly what they've done with the inventory here is really useful, because what that is saying is it is at the lowest it could ever be. So if you're going to make a decision and you're thinking we can convert this to cash, this is how much cash we think we'll get. So we're being very conservative. It's a worst case scenario. It has to be the lower of cost or net realizable value. And it's just that way. So we know that they've done this, they've told us, and the auditor is equally happy with it. There's no other, other note anywhere else to tell us we should think otherwise. So if I go back to that inventory, let's take a little faster route here. And I look at the value, and what I'll do is I'll compare it to last year. And what I can see is, not much of a change, a slight change, but sales have gone up. So it makes sense that I have more inventory there. And so it still seems consistent. Nothing's out of the ordinary, but I do see a huge cash increase here, which is kind of nice because that means I've generated sales. So the inventory turnover is probably not that bad. So the point here is, this is what inventory means. Okay, and this is how it gets there. And we know that it's at lower cost or realizable value. So I know that they can convert their inventory to cash. So if I begin to see this value decline, and it's lower and lower and lower from last year, it doesn't necessarily mean that's a bad thing. What it could mean is that I've sold lots of inventory, but I may not have purchased any to replace it. So, okay. Or I'm really quick at turning over my inventory. Okay, great. But there might be other reasons, but we don't know that just by looking at the inventory. So the other parts of the statements have to tell us the rest of the story. The inventory is just one piece. Now, maybe you missed it in the news late last week, but I certainly noticed it. Was a Canadian institution in retail called Le Chateau. It was open in the late 50s, early 60s. It was an icon. It started in Montreal, Canadian company, and was a really big hit, in the mid 80s. If you remember the fashion from mid 80s or have seen pictures of it, it's quite extravagant and colorful. But they always cater to a certain retail environment, prom dresses, etc. So for the last 5 or 6 years, they've been having a lot of trouble financially. And they were like the financial statements we would use to demonstrate really bad inventory turnover. We, for years, couldn't understand how this company was actually staying alive. And they finally filed for bankruptcy last week. And so it was no surprise, actually, for me. But it was just like, okay, finally, they cut the strings. It was just time to just let go. Because their inventory was so high, they just couldn't turn it over fast enough. I think the average inventory turnover was like every 460th day. Right. I know you're thinking, well, you have to sell your inventory like really much more regular than that. Exactly. And they could not do that. So their average inventory turnover was beyond 1 year, and that was not a good sign. And it just kept getting worse and worse. So the interesting thing, though, is that the company itself is no longer going to be operating, but there's spin-off companies from Le Chateau. And one of them you might be familiar with. The family name lingers on through David's Tea. David's Tea is owned by the Siegel family. The grandchildren are actually on the board of directors. So they are, I think one of them is president of the company. David is the grandson. So it carries on. So if you're a David's Tea customer, and if you're familiar with that brand, then that's another Canadian company as well. So that's kind of what I want to show you with inventory in terms of, a statement, and we'll see what happens. But this is a grocery chain. They always have high levels of inventory. This is a consolidated statement through multiple stores and all their holdings. So we expect to see higher inventory levels, but we know that they can turn it over. And we'll revisit this statement when we do a little bit more digging in terms of financial statement analysis.
Professor, sorry.
Yes, go ahead.
Okay, as you mentioned, so higher cash means higher sales, which is good. Receivables, so we're expecting money to come to the
Right.
company. So what about the inventory? I mean, it's better to have the high numbers, or if you compare to 2019, we have, as you mentioned, a little bit increase. So what does it mean? It means it's good, or we need to do something, or we need to make it like the difference between 2019 and 2020 should be higher or lower? How should it?
I think we look for stability, not necessarily higher or lower. I think we look for lower you know, in terms of maybe an organization that's having some cash flow problems, if they're liquidating inventory and they're trying to get rid of it and it's lower cost or market, we see capital assets being liquidated, then there's other indications that there's cash flow problems and they have higher debts than they can service. And so here I think we look for consistency. We look for, you know, this, you know, a sense of, I guess for me, just more of that safety net, that there's nothing out of the ordinary. It seems consistent from last year. If we look
Okay.
at sales here, if we look at the sales from last year, I mean, they're not really hugely different, maybe, you know, slightly higher, and that's great for growth. The inventory, if we turn these into percentages, you know, maybe we can see that change in growth over the year. We'll do that when we do a financial statement analysis, but it might be almost the same. So if we can relate the inventory to the change in sales or the increase in sales, it might make sense that that's happening. So, but remember too, when these statements are prepared, on May 2nd of 2020, they did an inventory count. So at that day, that's how much they had on hand. The next day it would probably change. So it's all over the place. So at the year-end count, it's consistent year to year. Like it seems to be that their operations really haven't changed much. And so that's reassuring for me as an investor or a creditor for that matter, because when we have this sort of, you know, consistent level playing field, nothing changes and not out of the ordinary, no spikes, no troughs, we're happy with that, like status quo, with a touch of growth every year. We don't see spikes of growth and rapid decline, but what we will be looking for, and this is across the board, is what happens at the end of 2021. What happened during COVID? This is the year. 2020 is the year where companies really have to come to the challenge and figure out how they're going to make this work. And I don't mean it just from a profit mongering mind, because I don't believe that everything's about making money and profit. It's quite the opposite, actually. But it's about creating jobs in communities. It's about keeping communities together. It's about looking at other ways of doing business that has a less impact on the environment. It's just different ways we can think of doing business. So if they can keep doing that in COVID, then maybe that's the model we look for. So maybe the value won't be in sales increases or value in retained earnings. It'll be the value of keeping this company together all across the country, because they do own lots of stores in communities that keep communities working and feeding their families and having those ancillary benefits within their communities and outside of them. So maybe we start thinking about profitability a little bit differently than we did in the past, and what that looks like from a sustainability perspective. So I'm ranting, but anyways, that's my hope. But you're right. I mean, we have to look at, you know, relativity as well. Like, does this make sense that sales have slightly increased and so does the inventory holding on that day? Yes, we can make a reasonable assumption that that's the case. So it's really when you're looking at things way out of the ordinary that's concerning. They may disclose what that is. Management will say, hey, you know, we had this really unusual experience, or maybe something happened in the supply chain, or something happened. We as long as we have an explanation, we're humans. We just want to rationalize why things have happened. And so I think once management does that, it gives us a better sense of why that is. So I guess my final point is, we need the numbers and we need the other information to put them together to make really good financial decisions with these companies. So yeah, it's just we have
I
insatiable
just have a
appetite for
question.
information. Go ahead.
Perfect.
Go ahead.
So if the inventory snaps in time, can that be calculated before the lower end date fee?
Sorry, I didn't catch that. It was going in and out a little bit. Your reception wasn't clear.
If
Can you go ahead.
inventory is a snapshot for the day, can be manipulated?
I still didn't catch it. Can you type that into the chat board, or it just keeps cutting out as you
Got it.
talk? Yeah, that'd be great. If you could type it in, that'd be great, and I'll get to it. All right, so I'm going to stop sharing my screen here, and then I'm going to There it goes. I'm going to share my my slides with you, and we'll go through some inventory stuff. Let's see here if I can find them for you. Inventory. I have two sets of slides. I'll show you this one first, I think. Okay. So these ones here, I'm just gonna, I mean, I'll give you copies of all these, and there are other copies as well. I kind of, you know, try to modify these a bit more in terms of how I'm going to speak to them. So they're not necessarily the same as the ones that you'll see that are already posted there as the sort of the go-to brands. But one thing that I want to talk about in terms of inventory and trying to, you know, help you follow along the material that's presented, what they begin to do is talk about this balance sheet and what's happening. And so as we spoke earlier, you know, what do I have and how did I get it? They start to bring this up in an early part of the chapter, and really just trying to think of the impact on the financial statements. So again, just thinking about what that might look like in terms of what statement is impacted and how it's impacted. And so I just sort of give you kind of a, you know, I've got these, you know, very popular merchandising companies, you know, REI, Walmart, Amazon. We have different wholesalers, we have the consumer, and basically we're saying, look, the main source of revenue for a retailer or merchandising company is sale of items. When we start talking in the second part of the course in terms of managerial accounting, we talk about production and manufacturing, but for now we'll talk about retailing, just because it's easier to understand what inventory is and the significance of it. So when we talk about significance of inventory, so if we go back and look at the statements that I just showed you, the Emerald Company, we're really just looking at it being, you know, the way that it was listed. So you notice that cash was first, then receivables, and then inventory. Current assets are listed in the order of their liquidity. So, well, cash is cash, that's easy. Receivables will be converted to cash within 30 days, hopefully. And inventory is the next liquid, because the intention is we're selling it as quickly as we can. Stores do not want to hold on to this inventory because it costs money to do that. The faster they can convert it to cash, the better. So they want to move it quickly, especially if they don't have enough space on site. They have to rent another facility to do that, and that chips into profit. So we have a lot of inventory systems. The larger companies anyways will have just-in-time inventory ordering, or the artificial intelligence will tell you when you should be ordering your inventory, because you're getting to that magic number of 2 and we're at number 5. So it's probably going to trigger you to order that inventory. So it just knows when you need to do that, but just to keep customers happy and to keep that inventory flowing. And we're not buying a whole bunch of inventory. Another practice that you may find, maybe this has happened to you, auto parts stores are very popular for doing this, and it's common practice that if you order a part, they cannot stock everything. They just can't. So what you'll do is you order it, you pay for it, and they'll ship it over from the major centers. So maybe it's from Vancouver or Edmonton or Toronto. They will order it from that main center and it will be available in 2 to 3 days. So they don't have to stock all of that inventory. They know it's a phone call away. They charge you a service fee for doing that. And there you go, you have it. So they're also protecting cash flow because they've sold the inventory before it's even hit the site, right? So anyways, that's a really clever way of doing it. And it's a good way to secure any lost sales. So the objective then is to sell it as fast as you can at the higher than a price than what it was purchased for. That's the whole idea of making profit. It's your markup. You need to know what attaches itself to the cost of inventory. It's not just the unit price. It could be the insurance for shipping it there, the shipping cost itself, any setting up, etc. So we have to think of other things that are also attached to the cost of inventory. But yeah, the objective is sell, get it out of the store as quickly as you can. Now, in terms of a merchandising company and measuring income, we really just have to think about, okay, what is the step here? This visual here is just really the income statement. And all we're doing is just kind of walking through to the very end. But this in here is identified as being, we don't see cost of goods sold in a service business. So auditor, an accounting firm, a law firm, engineers, not-for-profits, you're not going to see cost of the goods that are sold because we don't have any goods that are sold. We have services that we provide. So you're not going to see that. So you're not going to have gross profit either. So if we have service industries, you will not see the blue boxes, okay? But the interesting thing with gross profit, if you do have this, is what it really means. So what this gross profit is telling you is that this is how much you have left from sales to cover operating expenses. So the higher the margin or the higher the gross profit, the better. So if 60% of my sales revenue is retained after I pay for my inventory or whatever I sold it for, then that's good. I have 60% of my revenue to cover operating expenses. That's a really good place to be. Higher is even better. Not so good if you're hitting the 30, 35, 25% area, because that's getting really close to zero and you haven't covered your operating expenses yet. Unless you can really manage those operating expenses, then great, but it's just a less safe place to be. So that's what this is really trying to identify here, is the service versus non-service entities. So how do costs flow? Well, we'll see how these costs flow a little bit more when we talk about managerial accounting, but for the most part, what these arrows are saying is beginning and cost of the goods that I purchased all end up here in cost of goods that are available for sale. So if I buy my inventory and I've attached all the costs of those items that I've purchased, that's the cost of the goods that are sitting on my shelf, right? So everything that attached itself in terms of cost attaches it to that item. And then I sell it. So what I really want to do is make sure that what I'm selling it for is more than what that cost is of that asset. And maybe it's 300 times that, I don't know, whatever you want your profit margins to be. Or sometimes it's whatever the customer is willing to pay. Depends on how your pricing mechanisms work. And then when I sell it, it's the cost of the goods that I sold, and I might have an ending inventory balance there as well, because I can't really sell all my inventory. Just like we saw on the Empire statements moments ago, there's an ending inventory balance there. What that means is on May 2nd, I didn't actually sell all my inventory. I have some left over, and that is what it's worth, okay? The next day, May 3rd, it's probably going to change. But at May 2nd, that's what it was. So I can't sell everything. I can buy things, I can sell them, but at the end of the year, I'm going to have an ending balance. It's just the way it is. I don't know if I could ever clear my shelves for a year-end count. And this perpetual system they talk about, or periodic inventory system, is how we account for inventory. It's a matter of how I track it and what that really looks like. So the perpetual system is something you probably experienced before. You've walked into a retailer, or you've been grocery shopping lately, or you've just paid for something using your phone, right? So as soon as you've scanned that item, it's automatically being recorded. So two things are recorded: the sale and the inventory reduction. Two things. So as soon as you scan the item, it's perpetual. It's continuously updating your system, okay? It knows exactly how much inventory is on hand because it's always updating the system. So those point of sale systems were revolutionary because then we didn't have to count inventory all the time. Now, if you deal on smaller scales and you don't see the need for point of sale systems, or you do and it's really not that hard to manage, it means that we don't actually keep track of those inventory items on a large scale. So we could count them. So at the end of every period, we count the inventory. And, companies that have perpetual systems still do counts. I mean, you could do, every month you could do a run through your inventory and count it just to make sure everything's okay. If you have the ability to do that, if you have, the HR resources for you to do that, then highly recommend it. And if it's a well-organized inventory system, it really isn't that difficult to do. You just have to have it well planned. And then we have to calculate cost of goods sold. So we always start with what's sitting there already on the shelf, and then we purchase more. So we add more to the pool. And what we have left to sell is 900,000 here in this example. But at the end of the year, we know, or at the end of the month, I didn't sell all of that. I have 125,000 left. So guess what? My cost of sales must have been 775. And don't think of it in terms of units. What we're doing here is trying to cost that inventory and give us a value of the inventory, because we don't see units on the balance sheet. We see a value of inventory on the balance sheet. So that's what we need to do. Of course, we need the documentation to do that. And then this example here, we talk about, what's happening, what's the impact on the balance sheet. And we're talking about them receiving an invoice from an audio supply company. We bought it for $3,800. So how would we record this? What is the impact on the statements? Okay, what do I have and how did I get it? Well, I have a stereo, and how did I get it? Well, I put it on account. I didn't have to pay for it. They received an invoice. So this has no effect on cash flow yet, because I actually haven't spent any money. I've just told them I would pay for them at a future point in time. So I have the inventory. That is my increase. That's what I have. How did I get it? Well, I put it on account. So I've increased my amount I owe to somebody else. So I balance, okay? Everything's equal here. Nothing else has changed. No cash effect yet. When is the cash affected? When I pay for it. When cash moves out of my bank account. Okay, so there's no effect on the income statement yet. So now suppose that they return the goods and it costs $300. Okay, well that's standard. I mean, people bring things back all the time. We have to think about what changes from the original entry, right? So I get this and I don't really need this one, or there's not something wrong with it, so I send it back. So really what that means is I'm not going to pay for something I'm not going to keep. So again, what do I have and how did I get it? Well, what you have here is less inventory because you sent it back. And why is that? How did it get there? Well, it was something you didn't need, or there's something wrong with it. They returned it. That means I shouldn't have to pay for it. So all I'm doing is reducing my original entry. Okay, so that is the impact on the balance sheet. And that's fine. That means I owe less money. No impact on the income statement. So again, just working our way through that system about what's moving and what's not moving. So in terms of sales and perpetual inventory systems, most of the time we record it on credit. I don't know, maybe some people pay cash for it, I don't know. But what we're looking for is this obligation. When do I actually record the sale? Well, I record a sale when the revenue has been earned, which means I have received the product and someone has paid for it or has promised to pay for it. So I've actually gone through and decided that I have actually finished the sale. I've finished my obligation to do that. So the invoices are normally a good way to do that. So here we have an example of the audio supply records records the sale of $3,800 on May 4th. So now they're selling it and it costs them $2,400. So we have to think, what do I have and how did I get it? And what's actually happening here. So conceptually, I have a sale. So I have to record the sale and how it's paid for. But I also have to think about the inventory that's moving as well, was underlying all of this. So there's really a few little pieces here. So I know that I didn't get cash, but I have a receivable, and we know that receivables are a promise to pay. I want to buy this item, but I don't want to pay for it today. So put it on my account. It's on credit. So, okay, accounts receivable is a promise to pay. So hopefully that switches to cash fairly quickly. So I have a receivable. Well, how did I get the receivable? Well, I made a sale. So retained earnings is part of this. It's a revenue which increases retained earnings, right? Eventually it folds in there because it's part of profit. That's how we calculate profit. Now, that's great. So I've got my revenues and my receivables. Good. Okay, that's one side of the sale. But what happens to inventory? How is it moving through? What's the impact on the financial statements? Well, it's good because I've sold it. That's exactly what I want to happen. So I'm going to see my inventory going out the door. Great. But what's the other side of that? Well, it's an expense and is going to reduce my retained earnings because it's the cost of the sales, right? The cost of the goods that I just sold. So I'm recognizing the gross sale, the total value of the sale, and I'm reducing that gross sale by what it cost me because I didn't get the merchandise and inventory for free. It cost me money. So the difference between the 3,800 and the 2,400 is profit. Okay. So we have to make sure on a sale that we record those two transactions because two things are actually happening at the same time. All right. You've probably done this. I know I have. Sales return or an allowance. If they don't want the return, they give you an allowance or a discount. The key thing with from a manager's perspective, why would these be important? Like, what's the significance of these? Well, we can't in accounting touch revenues directly. We can't change that. We're not supposed to. So what I do then is I have these other accounts. They're contra accounts. So I have a contra revenue account. And the way it works in accounting is if revenues have a credit balance, these contra assets have a debit balance. They're going to offset each other. One's negative, one's positive. So what I'm really doing is saying, look, I have all these sales, all this revenue has been generated, but I have a customer that came in and returned an item. Well, some will say, well, why not just change the sales then, just reverse it? Well, we could, but then we're not collecting data. What I really want to do from a managerial perspective, I want to measure the amount of returns, the rate of returns and allowances and sales discounts. And when I do that and I get the result, I go, wow, 10% of our sales are being returned, or this one item is being returned. What is going on? Well, maybe the product quality is not where customers want it to be. Maybe it's breaking, I don't know, wrong color. It could be for any reason. What we want to do is look for trends. Is it the same product? Is it the same customer? What's happening here? And why are there so many returns and allowances? There could be something else going on. There could be a scheme. Okay, so we want to look for those. And we wouldn't be able to measure it if we buried it in sales. It wouldn't surface enough. So what we want to do here is measure them separately. The other thing with discounts too is you can actually trace, with all this great technology we have now in sales systems, we can trace who granted the return, who authorized a discount, or vice versa. And then we can measure it. Who's allowing all these discounts and what kinds of discounts are they getting? Okay, because a discount is a lost sale. It's revenue that we're losing. It's chipping away at profit. So I need to know what that looks like. And if we get our monthly report and go, wow, sales discounts have been like on average 30%. We haven't had any sales. What's going on? Or sales returns. We can identify products that are returning much faster than they should be normally. So we're trying to identify anomalies and potential problems with maybe some staff that might have some friends that like to come in and do some shopping, or managers that aren't doing their job. So we can get a sense of what this looks like. So we use these contra sales accounts or contra revenue accounts. So what would this look like in our last example if we had this return or allowance? Well, if you really think about where the inventory is going, you're just saying, well, it's coming back. So the entry you made originally is actually just being reversed because we've sold something and then we're going to put it back on the shelf. So this is an example of the return. So what that means is I'm going to collect $300 less because I actually didn't make the sale in the end anyways. and my revenues will go down. But that would be through a contra account, like the sales return, because we can't touch revenues directly. And then it cost me $140. So what I'll be doing is saying, look, put the inventory back on the shelf at the cost of $140, and my expenses will change because I didn't actually sell it. So I'm adding it back. The expense actually never happened. So there is impact on the income statement through revenue and cost of sales. And there's also impact on the balance sheet in terms of inventory. No effect on cash flow yet. I know it's a lot. This is an example here. This is right from your book. I don't know that I need to go over it. Fairly straightforward, exactly what we've just been doing. But I just put it on here just to draw your attention to it and see if you can walk through that example in the book. Of course, the slides that I post will have all the answers for you. But just, and I think we talked about this at the beginning of class about what this really looks like. So here's one of those examples. And can I walk this through the table and understand what's happening? So what do I have and how did I get it? So again, just walking through and seeing what the impact is. In terms of inventory systems, remember the Empire Company statement we looked at the beginning of the session, it was a value. And so the perpetual inventory system will really give us this update every time we sell inventory or acquire it. Periodic, we'll have to do counts and we'll have to match it out to the books and make adjustments where necessary. And that's fine. But what really comes down to it is, it doesn't matter what system we use, we still have to do counts. Even if we use a perpetual inventory system, guess what? We still have to count it at the end of the year, and it is no fun. Although you can make inventory counts really fun. You can make it a party and everyone gets involved and you just buy everyone dinner and you just go to it. So it can be fun. Accounting can be fun if you make it that way. Anyways, onwards and upwards. So the key thing here that I want to talk about was the differences between these two types of companies. Now, we'll be talking manufacturing after the unit test, the midterm. We saved that for the second part of the course, but we really just want to know how do we classify and determine the cost of inventory under a periodic approach. So there are a few assumptions that are used. Now, they're quite easily understood. What you need to think of again is that Empire Company statement. The value of inventory, not the number of units, the value, lower of cost or net realizable value. Inventory has value. So how do we value it for the financial statements? That's what we're doing here, determining the cost of this inventory. And specific identification is fairly straightforward. I'll give you an example of where you'd find that. And then we think of cost flow assumptions to value our inventory. We do not use LIFO in Canada. We used to many years ago, but it doesn't map out to taxation very well. It's too easily gamed or manipulated. So the tax department doesn't like that. And then a weighted average cost is another one that we use as well. So three main types of inventory in terms of specific identification, which is first. So this one is, I don't know, an art gallery, a car dealership, maybe a smaller one, you know, big ticket items, maybe a stereo shop. The items are easy to find. They're big. You can identify the cost really easily. You know if they're missing or not. You can go and look at them. There they are. So you can specifically identify the item and attach a cost to it. Nice and easy. So what we're looking for is when we value the inventory, we have to think of how does it flow through, and we're going to catch those costs as they flow through. So specific identification, they're saying, look, they purchased 3 identical TVs at the dates below, $700, $750, and $800. Okay, well, great. And then we sold 2 TVs on June 1st. Well, good. I mean, basically, those are easy to identify. Specific identification. We know exactly what they cost. And we know exactly how much is left in inventory at June. So again, it's just a way of trying to figure out how inventory is moving. So if they sold the TVs at purchase February 3rd and May 22nd, then they're telling us the cost of goods sold. Think of how inventory comes in to the warehouse, okay? So I have ending inventory that's sitting there and I'm doing my year end and I need to value inventory, just like Empire Company did. So what I have to think about is, okay, well, how am I costing this inventory? Well, what I'm going to do is say, all right, well, whatever is in that inventory pile, what came in first or second or third, etc. And I'm going to value it that way. So they're saying here that the first TV sold for 700, or sorry, the cost of goods sold was 700 and the other one was 800. So the cost of goods sold of all those TVs was $1,500. And then I'm left with 750. So the ending inventory is what I'm left with in terms of how those sales happened, okay? So I'm left with the TVs that did not sell. The other ones that sold May and February are gone out the door. So we're just looking at when inventory comes in, for the most part anyways. Some inventory never leaves. We buy inventory and it doesn't move. And then we eventually have to just sell it for cost or write it off because we just can't sell it. And those are, industries like maybe technology, things that go obsolete very quickly. Computers would be a good example. But in specific identification, physical flow costing is pretty rare because we know where those items are. Like you think of an art gallery, inventory doesn't move all that fast. And if it does, it's gone. So we can just go up to it and say, okay, October 31st, yeah, we know what's in the gallery. We can pretty much cost it that way. We don't have to know about the flow of that inventory because we know exactly what's there. So it's more rare that we use specific identification. There's really not a lot of small type places we could use this, but it's just not to say we don't. If that's what management feels they would like to use, then let them use it. The majority is FIFO, first in, first out. I'll give you some examples of what that looks like so you can visualize that first in, first out and an average cost. Now, I don't expect you to calculate these, but what I'm doing is I'm showing you how they get to this, because if we understand how they get there, it's easier for us to go, oh, they use perpetual inventory, or oh, they use periodic inventory. I know what that looks like for them. I know why they got to this figure. So in terms of the cost flow assumptions here for Astro condensers, we're really just looking at this very standard formula. Start with the beginning inventory. That's what I had at the beginning. I add my purchases. I take off my ending inventory. Well, whatever the difference is with that must have sold because it's no longer here. So it's a really good way to count that. What I'm really trying to do here is think about when did I get those units? So I'm looking at the dates. I'm looking at when I purchased items, when I purchased them, what I purchased, how much it cost me, and then what I have at the end of the period. So I must have sold 550 units. So again, just trying to run through the concept of what's happening here. Now, first in, first out. Let's see if I have my picture here. Pretty sure I do. Okay. This will say 1,000 words. So we don't even need that previous slide. First in, first out context. Now, this is just understanding the flow and movement of inventory when we cost it, okay? It doesn't mean that's how inventory is sold. It's just how it moves through in a first in, first out costing. So think of a vending machine. You put your money in, you type in the code, and whatever you want drops in. Okay, good. That was the first item in, right, in the vending machine, and it's the first one to come out. So think of the person filling the machine. I'm sure you've seen this before. So when they fill these machines, they start from the front and they load back. Why? Because things expire. They have expiry dates. So what they'll try to do is put the one that's going to expire first, they're going to put it up front. That's the first one in, and in it goes, okay? So as I fill back and fill up, I close everything up and lock it away. As soon as somebody puts money in, it's the first one in, it's the first one out, okay? And this is how we cost our inventory. So the inventory that I bought 7 months ago is still sitting in my inventory. I'm going to take that inventory item first before I take the next one, because the first one in is the first one out. I'm going to account for it first before anything else. So that's the concept. So think of the vending machine context when we cost inventory, okay? It's not how it's sold, okay? Things can sell in very different ways. It's when we cost it for the financial statements, okay? That is the system. So the vending machine concept here. So if I take these dates, this is my cost of the goods that are available for sale, waiting there on my shelf to sell. So if I say, look, I started with 100 units, I bought all this inventory, I have 1,000 units at the end, this is what it cost me. What I'm going to do is go, okay, well, I know what it cost, but what do I have left today? What do I have sitting here? Okay, so I need to start valuing my ending inventory. So what I'm going to be doing is taking the November, I probably sold these, but I've sold some items here. So, right. So the total ending inventory that I have here, based on the November 27th and August 24th, cost me $5,800. The next thing is, how do I get this allocated? Okay, the cost of goods available for sale are still going to be the same. So in terms of FIFO then, what would that look like for the balance sheet? And where do I use this? So cost of goods sold, we know will end up on the balance sheet, or sorry, the income statement. That's my expense for the year. That's what I have, and that's what I'm going to expense. But I still need to think about the inventory on the balance sheet. So I need to go back and think about, okay, if it's first in, first out, whatever I have left, I'm going to go back to that older inventory first, and I'm going to cost it based on that. So I might have some inventory that cost me less, so therefore the value is less. And so some people don't like that because they want to inflate their inventory for the balance sheet because they like to see those big assets at the end of the year. But some cases, we just have to go with the oldest, and that's just the way it goes. So in terms of first in, first out, this is just another way of trying to, I guess, visualize the way inventory is going to move in terms of costing it. And so they talk about this other way, last in, still here. All these acronyms they can come up with. So last in, but still here. All right. So kind of the same idea. I still like first in, first out. I like the vending machine idea. So what we're saying is, look, we had all these cost of goods sold. This side, these sold, they're gone. Okay. But I still have these down here. They're in the warehouse, and I need to make sure I cost them properly for my financial statements. And that's what I'm going to do. I'm going to look and see when I accumulated the $600 and when I accumulated the $5,200. And I'm going to go first in, first out in terms of costing. So it's a bit more work, but in terms of trying to understand the flow of inventory, if we know, and most cases, there'll be two methods in Canada. For first in, first out, FIFO or average cost. Average cost is much easier and it takes less time to do. So you probably know where most companies land. Good enough, right? It's good enough.
Yeah, I was wondering about that. Sorry to jump in.
That's okay.
I happen to run a fashion company, and the company went from 0 to 10,000 pieces of jewelry within a year. So this whole inventory management thing was quite the struggle, and that's what I ended up doing, the average costing, and especially that everything is imported, and I would restock everything 2, 3, 4 times. The first round of stock that I would get would cost X amount of money, but then between the duty that would change because the inventory is getting bigger and my cost dropping because I'm ordering more and the dollar fluctuating, the first shipment would be completely different than the second shipment and the third shipment. And when we came to close the fiscal year, it was just much easier to just round it all up to an average. Does that make any kind of sense?
Absolutely. That's a very common way of doing it. And it's interesting that you brought in the foreign exchange because the company that I do contract work for orders a lot of their inventory from the US. So we have foreign exchange gains and losses all the time. And so when you incorporate the foreign exchange differences in your inventory, whenever you order it, it's going to change because the US dollar fluctuates so much and we don't have control over that. So we do find it easier because it's it's such a lot of work to track it. And if you think about the labor cost to do that versus an acceptable way of doing a weighted average cost of inventory, it's much easier. And especially if you're buying similar items. So if it's a similar inventory item, you can do an average cost of inventory for that category. So it becomes much more manageable. And in terms of time and labor cost, it's a huge cost saving as well. And it's acceptable. It's a reasonable approach as long as you document it with working papers or, count sheets. You have two people running through the counts. One person does the one, the other one checks it. Then it's an absolutely good way of doing it. But the key thing too is that it's the same every year because we're using comparable information, that if we're doing average every year, it should be noted that we're doing it every year. If you change the method, you say, we were using weighted average and now we've switched to first in, first out. You need to tell the users that. And the other key thing is you have to convince them why you think it's a better method than the previous one. And the other thing to that is that you can't keep flip-flopping back and forth between the two. Users won't like that because they can't follow it. They can't compare it. So yeah, it's becoming one of the ones that you stick with, and it works. The weighted average works really well and it's acceptable. So I'm glad to hear that you've been using that. It's probably a lot easier than doing it the other way.
Yeah, thanks for your feedback. And it was becoming even more complicated because everything would go to Canadian dollar, like averaged, and then translate again. We would sell in Europe and the US. So like it was becoming so complicated. And the cost of labor, that's exactly what you said. Like I would spend thousands of dollars just in accounting. So I'm glad to see that like this is a okay method because
Absolutely.
I would much prefer to have everything accounted for the correct way, but it just became like crazy. Anyway, thank you so much for your feedback.
Yeah, no, it's good. It takes all, and the larger the companies, the more labor it costs to count that inventory. So the best way we can do it is the easiest way, but it doesn't have to be 100% accurate. We know that that's probably impossible, especially with a big company, because things break, things go missing. You have people in the warehouse. I mean, you have controls in place, but they're not 100%. But we know that if we can manage those controls and be consistent with the controls, it's a better chance of it being, accurate, but we cannot ask for 100%. So as long as it's fair and reasonable, and it's a good control mechanism as well, to keep it consistent from year to year. But yeah, I love the examples. That's great. I know we don't use LIFO, but the US does. They have US GAAP. And US GAAP still allows last in, first out. And the last in, first out context is this freezer. So I don't know, my grandmother used to have one of these. She used to do lots of baking and had berries and stuff. And you'd throw things in, right? And then all of a sudden, the more you throw into these, the less you remember they're in there. And so things become buried. And so what happens is when you start getting your freezer full like this, you begin to take the stuff that's on the top out first. So it's the last in, which is the top row, is the first one out. And you can see how this is manipulative in terms of a tax concept, because if we can manipulate the cost of inventory for tax purposes and expense it for tax purposes, we can really game the system and we pay less tax. So the government in Canada did not like last in, first out because we could manipulate it too much. But this conceptualizes last in, first out in terms of the freezer. So everything in the bottom really just gets forgotten. And so it would take us a while to dig to the bottom. And the most current cost will be on the top here, the last items in. So anyways, LIFO is not, I don't go into it much because it's not allowed in Canada. IFRS also does not allow it, but US GAAP still allows for it. So you might see it come up if you're looking at a US company. And so I just threw the example on here, just in case you are looking at a US company and then you have access to it. But anyways, you can just see how that works here. The book does talk about it, but I'm not going to examine it. So it's just here for your enjoyment, for your entertainment. But if we compare these two diagrams, we can see how different these are. For FIFO, we knew that all of these other items up top here were already sold, right? So if we're going to cost inventory, we're actually going to be looking at the last in, first out. So again, it's not going to be as accurate as it could be. So again, we just have to think of the way inventory moves in terms of costing only for the balance sheet, not how it actually moves and sells. It's just a method that we use to track it. So in the notes to the financial statements, if it's saying we use FIFO to cost our inventory, lower cost or market, great. That's all we need to know. But it has to be consistent. And so again, we were talking about this moments ago, but the weighted average cost, we just do that. We just take all of the cost and weight it out between all of the inventory units. It's easier, especially if you have a lot of homogeneous or similar type units, or that counting it is just not financially viable. It's economically unrealistic in terms of costing. So would you rather just do a quick calculation and a quick count, or have somebody actually cost you a lot of money to count every specific unit? You'll probably opt for the weighted average because it gives you a good enough inventory item figure. And again, it's a lower cost or market anyways. So if we've written anything down, we would have seen this already in any method that we use. So we're only looking at inventory that actually has value on the financial statements that we could sell. So I know your book goes through this in a little bit more detail, but I do want to talk about it here. So what the key thing here too is in terms of this costing method, again, we're just taking, what it cost me and how many units I have. It's $12 per unit. Great. I just spread it amongst all those single units and I can cost my ending inventory here at whatever's left. So I have 450 units left at $12 per unit. There's your $5,400. So it's nice and easy and reasonable, actually. But one thing you might want to do in terms of assessing these methods is to look at what the difference would be. And what I mean by that is, what is the bottom line difference? Now, these ones aren't giving you too much of a difference, but they are different. So as a user, we need to understand what significance this has on the bottom line. So if I'm going to be using this ending inventory, which gets me cost of goods sold, means I haven't sold this yet, right? So I'm calculating that ending or that cost of goods sold. What it's saying is I have 5,800 in inventory versus 5,000, okay, or 5,400. So not a huge range, but you'll see that LIFO gives me less income, which is why the income tax department in Canada didn't like it. But 300 and change difference between these average cost and FIFO. So not a huge difference, but enough to make a little bit of a difference. So they aren't going to be the same. So that's why you have to disclose which method you are using. And they're all acceptable under international reporting standards and GAAP for private companies. So one thing too to think about in terms of your decision-making ability and what method companies use to cost their inventory is that we have to think about the impact on these statements. So what kind of impact would it have? And what kind of impact does it have on the balance sheet and the income statement? So if we think about, inflationary periods, FIFO would probably produce higher net income because we have lower unit costs of the first unit. So they're going to cost a lot less if inflation has happened throughout the year. It's going to cost me more for inventory at the end of the year than it did at the beginning of the year. Inflation, LIFO doesn't matter because we don't use it in Canada, so we don't have to worry about it. But it just seems to talk about those two more so than the average cost. The average cost, because it's a balance of everything, even inflationary periods or not, is combining lower cost and higher cost items and averaging them out. So whether they're rising or falling, average cost produces net income between that FIFO and LIFO somewhere because it's capturing both bookends. It's capturing FIFO and LIFO and everything else in between. So that's normal to see that distribution. And the balance sheet effects. So the advantage of first in, first out is that during inflation, the costs allocated at the end of the inventory will approximate their current costs. Well, that's right, because it's the most relevant purchase. So it makes sense that that would happen. And I just put LIFO in there just to show you what the difference would be. But like I said, in Canada, we do not use it. So we're not going to worry about it. This is another example that I draw your attention to try it and walk through it, just so you can see how it works in terms of using a FIFO system. Really just walking you through the number of units and what that's going to look like in terms of a periodic system in using FIFO for costing. So again, they're just taking first in, first out, first in, first out, and you just work your way down. Okay. LIFO, of course we don't use it, but I show it just for fun. So, but you'll notice how they're going from bottom up, not top down. That's the difference. That's the flow of inventory, last in, first out. Average costs. Again, we just group them all together and we take the number of units, and the average cost is $360 per unit, and we see how many units are left in inventory at the end of the year, and we have 25,200 worth of ending inventory. So that's how that will look. This was is a local company. You may be familiar with it. It's in Vancouver. It's called Mountain Equipment Co-op, and they've been in the news lately. And not a lot of people are happy about it. Actually, it's been in the news for a couple of reasons. The one is that last year their earnings, well, there weren't any. They're in a loss position. And so there's some rumbling about that maybe Mountain Equipment Co-op wasn't doing as well. And this is an iconic store in Vancouver. It's been around since the early 70s, all about outdoor adventure type sport, etc., outdoor camping, anything recreational. And it's an iconic store in Vancouver, and they just built a brand new location, brand new head office, and it's beautiful. But there are inklings about its sustainability, and they're talking about the latest report on earnings at that time, and they weren't sure that they were doing that well. They were losing money. They just built this brand new beautiful store and headquarters, really expensive in Vancouver. And so if you went and looked at the statements, an eagle eye, anyways, one with a bit of background in financial accounting, would know that there are items on there that were one-time things and depreciation that's non-cash. And it wasn't really about, net income isn't cash. It's just an operational result. And so there were things on there that you could move around and get a better picture of what was happening. But fast forward to about 2 or 3 weeks ago, when the news hit to say that Mountain Equipment Co-op was sold to a US company. This did not sit well with Vancouverites, because it's a Vancouver store. It's a co-op, which means it's owned by you and I. We buy shares and we are an owner. It's a cooperative. And so that's how it started. And those roots have remained with it for over 50 years. And now it's sold to a US company. So whether it's because it was in trouble financially, which were a few inklings, we will never know. It's a privately held company, so we don't have access to that. But the key thing is with Mountain Equipment Co-op is that they sell a lot of inventory, and their inventory wasn't moving. However, COVID got a lot of people outside. And so they've been saying in the last little while, they cannot keep stuff off the shelves. Like it just keeps going out the door. So it turned around a little bit. So would profits turn around? Maybe, but guess what? It's sold anyways. So there may have been problems earlier on, but one of the big things was inventory. They weren't moving it fast enough. There was a bit of a dip, but that was before COVID. So it'd be interesting to see what happened. But the reason I show MEC is because it's a local company. They were having problems. They looked at the financials to determine that, but didn't look anywhere else. And they just started adding all these things, change in management, brand new store. They spent a lot of money. They weren't selling very much or as much as they thought they would. And so it just kind of leads to the storyline. And I don't have access to the statements because, like I said, it is a privately held company, but it's certainly one that you can look up and read a little bit about it. People were getting a little nervous in terms of this company. So I don't know if it'll come back. We'll see. But moving forward.
Excuse me, Prof. Sir, just a quick
go ahead.
question.
Sure.
Regarding the company that you were talking. So you told that it's a co-op actually company, but you don't have access to the segments and all these things. How does it work? So I mean, if it's if it's owned by people, so why we can't have access to those information?
Yeah, so as a public member, so if I went to their website, I don't know that I could find financial statements. I actually haven't looked, maybe they published them, but at the time they weren't available. So London Drugs is another example of a privately held company in BC, and you can't access their financial statements because it's a private company. If you're a public company, it's publicly available. So shares wouldn't normally be offered, but because the Mountain Equipment was a co-op, the shares are actually, you're a share owner. So you buy, like credit unions are the same, you buy $5 worth of shares and that's your membership. And so you would have access to those records if you were a member, I'm sure. But I'm not even sure, maybe I haven't, if you want to check on their website to see if it's there, but I don't remember being able to find those statements before unless they've recently put them there. But it is a co-op, and you're right, the members would have access to that because they would see them in the annual general meeting. Or if management decides that they want to make them public, they can certainly do that. That would have to be a decision of the board of directors. And but it's not common practice to make private company information public unless there's a reason to, unless there's a reason for it to be public, or if it's something that management wants to happen, then they would have that there. But the members, the co-op members would certainly have access to that, but the general public most likely would not.
Thank you.
You're welcome. Yeah, it's a great store. If you haven't seen that, it's a really good store for you outdoor enthusiasts. So anyways, moving forward, just reviewing that chapter 5, I will be getting the assignments ready for you in Wiley Plus. I'll have access to that tomorrow, and then look for those, they'll pop up and you'll have quite a few attempts to get those. But if there's material that you're struggling with or you're not quite sure of, or you think you're getting, but then you do the assignment questions and you're really not sure, please let me know and I can tailor any of these seminars to that. I'd be certainly happy to do that for you. I certainly don't mind. Here to help you as much as I can, and going forward. So reading the chapter 6 material, looking at receivables, that's the only part we didn't look at. We did look at the inventory because that's it's a little more complicated than the receivables. If I have some time, I can put my video together for you as a resource, or we can talk about it next week, because we don't have, well, financial statement analysis is actually quite straightforward, as so is straight line depreciation. So we may have some room to fit it in there. If not, I will do a video for you and go forward with that. So are there any questions that anyone has right now? I'm just actually going to go to the share, or to the main screen here to answer your question from, there was a question earlier about, oh, right. So I see your question there, Adrian. The inventory systems. Yeah, I mean, I think that the methods still remain the same. We still have, even though we're moving into different models, our inventory is still there. We still need to deliver that to customers. So we still have that asset. And so as long as we still have that asset on the balance sheet, we still need to value that asset. We still have to establish that. So if we're looking at a FIFO or average cost, that's been the standard for so long. I don't know that there would be another way to do that, unless international reporting standards or the accounting standard setters decide there's something better. And the way that works is the standard setters will get some information from industry saying, this isn't working for us anymore. And so they'll research that and go, oh, well, that's a good point. We didn't know that. And then they'll do some research, and they'll have, some inquiry, and then maybe a few years later, they'll change the standard. But until there's a problem with something that's not working for users of financial statements, or there's a better way to understand financial statements, they probably won't change the standard. So even though business models change, inventory still kind of has the same characteristic, doesn't really change. Yeah. But good question. Charles, did you have a question earlier? I think we tried to connect with you and it wasn't going through.
Yeah, I did. Can you hear me now?
I can hear you now. Yep, that's better.
Yeah, what I was trying to say, since inventory is a snapshot of a day, can it be manipulated by the company, basically?
Mm. Yeah, I mean, I guess it kind of depends on when your reporting period is and what's in it for management. So they could time the orders of inventory. They could say we purchased the inventory. You might not have received it yet, but you can manipulate that as much as you can, or delay it if you're worried about cash or liabilities, because if you're going to a creditor and you want to apply for financing, the last thing you want to see is increased liabilities on your financial statements. So maybe you put the timing off. Management's like, I'm not really going to order that yet to reduce the liabilities, or it really just depends on what the objective is of management and what they're trying to achieve and what the impact is on the balance sheet. If I don't order the inventory, I have less of an asset on my balance sheet. So if the bank is looking for assets, then I should order the inventory. And again, it depends on the volume of inventory that you're buying. Sometimes there's a better cost the more that you order, or the timing of your order sometimes makes a difference as well. So again, it's just a matter of trying to play the game, right? And who's to benefit from that. If there's no benefit for anyone, there's probably no reason to feel like you have to manipulate any of that sequencing. My experience. I hope that helped.
Yeah, thanks.
Great, thank you. Good question. Any other questions about anything tonight or coming up? Excellent. Okay, well, I'll stop recording.